Hey guys, how's it going? Today I'd just like to talk about, the market is down a lot. Today it's over 2%. S&P, NASDAQ is down like 3%. And a lot of stocks have come down. And I just want to give my opinion on some very big mistakes that a lot of investors will make. And, people get excited when stocks come down a lot. It's the end of the world. But I just think I see a lot of people on Twitter kind of making these mistakes. And if you've been investing for a couple of years, you'll know why these three things I'm going to talk about are very, very big mistakes. And I feel like I'm qualified to talk about this because I've, for the last couple of years, I've had some decent results to show for myself. So I think the first really big mistake is you care too much about the macro environment. There's nothing inherently wrong with trying to understand the macro environment if you're interested or you're trying to invest in specific things. For example, when rates are higher, you might be interested in a REIT, right? The REIT price will be a lot lower, but they'll be offering like a 5 to 6% dividend. You take like Realty Income, for example, or MPW, so something like that, VC. You might want to invest in a REIT if rates are higher because they'll give you that dividend. But in general, you don't want to care about the macro environment too much because you don't have the tools to know where the macro environment is heading. And the only reason I'm saying this is because, even the most educated people, the people who study different curves and understand how the Fed is going to do specific things, even they get things wrong on a regular basis. So if, not that you shouldn't try to understand these things more, but if these people who are very educated consistently get things wrong, who have the best tools available to them, I don't think you should put too much thought into where the macro environment is headed. Rather, you should find whether a business is good or not, and if it's going to perform well in the future. If you think that it will, then at the right price, you can buy it. So that's what I really think with regards to that. The second thing is you care too much about analyst price targets. Okay, and I'll just give an example of this. Ulta Beauty. Analysts have been reducing the price target, and they haven't even reported earnings yet. So, this is common with a lot of other stocks. Another stock that I own is Lululemon. Analysts have cut the price target. And analysts will just anchor price targets, right? If a stock goes down a little bit because maybe that sector is getting hit hard, they'll just lower the price target, even though they haven't had earnings. So nothing has fundamentally changed with the company, but they'll give it a lower rating. So maybe they thought it was $400, but now they'll rate it with $300. But nothing in the fundamentals have actually changed with the business. Or at least none that anyone knows about publicly yet. So this is another thing is, you should look at the research that analysts do because a lot of the research is actually very good. They have a lot of different charts and a lot of that is very interesting. You can make some inferences about earnings per share or revenue growth, but you shouldn't put any merit whatsoever into their price targets because their price targets change as a function of price action and not of the fundamentals of the actual business themselves. So you only want to change your thoughts on a business when you get the actual earnings results or when something new happens in the company. So if you don't know what's going to happen with the earnings, then you shouldn't change your price target. If just because a business goes from $300 to $100, if they haven't reported earnings and nothing else has changed in the business in their filings, then you shouldn't change your price target just because the stock's down 60, 70%. So don't bother with the analyst price targets. Look at the fundamentals of the business, how much it's growing, etc., etc. So the third biggest thing is caring too much about price action or the past performance of a stock. So I think this is a very, very big mistake. So, and I'll give a classic example. You can find tons of examples. Intel's another one, but a classic example of this is PayPal stock, right? So someone today could be looking at this stock and be like, hey, well, we haven't really moved from, 2022 to 2023 until now much. So why should I buy this business? And this is a fundamentally wrong way to look at investing in a business because the way you want to invest in a business is you want to see how their metrics are improving over time. So you could say that, but if you don't take a deeper look, you wouldn't know that, the earnings per share from 2022 to 2024 have gone significantly better. You wouldn't know that their free cash flow has gone up better. You wouldn't know that the business has actually gone cheaper because they've bought back a lot of their shares outstanding. And you wouldn't know that their revenues have increased by, 8 to 10% every year. So these are things that are not necessarily inflected within the stock price itself, that you shouldn't just look at the previous price action of a business. What you need to do is completely ignore what's happened with the stock in the past. If a stock goes from here's $90 to $300, it can still be undervalued. If the business got that much better, it can still be a bargain at $300. What matters is the fundamentals and the numbers of the business. Similarly, if a business goes from $300 to say $60, $70, can still be a bad business. Just because it dropped 60 to 70% doesn't make it investable or make it something that you should invest in. So what you should be doing is you shouldn't care about the actual previous price of the business. What you should care about is what is the today's price of the business and how much is the business improving. So if the current price of the business is good and the business is improving, then you can look to make a position, right? It doesn't matter if the stock has been flat for 2 years, the business is getting better, then you can buy it. Doesn't matter what happened in the past. What matters is right now. Price action does not matter. If the business is good and that price you think is cheap for whatever good you're getting, buy some stock. So I think these are some very big 3 mistakes. People are caring too much about things like the macro environment, what analysts have to say, because their price targets are always they'll always change it depending on what the price is. They just anchor it to whatever the current price is. And they also care about the 5-year performance of a business or 10-year performance of a business, of the stock price of the business. You should not care about what the stock has done. You should care about the fundamentals of the business. And generally these should line up in the long term. But sometimes, you can have moments where the market's not necessarily rational and you need to exploit those. So, you can't just assume just because a business has gone up like 100% that it's expensive. Look at the business, it still might be cheap. You can't assume a stock is cheap just because it's gone down 70%. You need to look at the business. If the revenue deteriorated, by a large amount, if their operating income has gone down a lot, if their margins suck, then it's still not a good buy, So you need to look at all these things. These are very big mistakes I see people make all the time, and I've made in the past. But just keep these things in mind.